talk us through what we're seeing in the debt rather than the equity here.
Right. So the equity response, is largely due to, like you said, that fatal car accident out in California. Most debt investors would tell you that they're most concerned about the downgrade right now. So there's a section of buyers who either can't hold the bonds now because they've been downgraded to CCC. So you've got some, on the one hand, some forced selling action. On the other hand, there are people that probably were looking to get out of these bonds probably since they bought them. And granted, this is not the best time now that they're down to about 88 cents on the dollar, but certainly the downgrade adding to more of the concerns that we've already been hearing about Tesla, the persistent negative cash flows. When is this company going to be profitable? And you can see that in how the bonds are trading now.
Now, you've got a whole story on this, and I want investors, people watching, to go read this because it's really quite fascinating. I mean, they raised cash in August of last year at around 6%, actually below 6%. Obviously, now that downgrade. What were potential investors telling you about what return they'd want to see, what interest they'd want to see in order to give these guys money again? Because this was fascinating.
Right. So those bonds, it was, I mean, most people would tell you it's somewhat of a miracle that they were able to price as cheaply, for Tesla at least, as they were at that 5.3% coupon. Most investors who I talk to now would want more than double that. So we're talking at least a 10% yield for bonds that are due in 2025. And even at that point, that's only to get them somewhat interested. That's still not even enough for a lot of the people who I talk to.
Yes, you're talking like a CCC price. If we're talking 11% in that range. Right. Wow.